Hello, everyone, and welcome to our financial webcast today, titled The Banking Crisis and Debt Ceiling Standoff. My name's Dan, the moderator for the webcast. Today's webcast presenter is Jim Holtzman, CFP, CEO, President, and Wealth Advisor of Legend Financial Advisors. Please hold as I turn the broadcast over to Jim.
Okay, good afternoon, everybody. Thank you very much for joining us today. There's a lot going on as it relates to the debt ceiling and the banking crisis. And, I just double checked this morning before hopping on for this presentation to make sure nothing has changed at this point, because it is a very fast moving area right now. So our goals will be to really get through, hopefully, and provide an understanding about what has taken place in the banking area and the banking crisis that has evolved, at least with a handful of banks. We'll talk about the debt ceiling, some of those ramifications on what could happen if we actually push the limit, if you will, in this case, and most importantly, as it relates to what do you need to do as an investor to navigate through this process that we're going through. And I'll give some ideas of what we've been helping our clients with and how we analyze these situations. So with that, we're going to jump into talking about the banking crisis. And what I've pulled up, the first few slides are going to be related to SVB, which is Silicon Valley Bank. They're kind of the bank that got things up and running as far as the current banking crisis goes. And this chart, what it's showing is it goes back all the way back to 2019, but it shows basically net deposits and net withdrawals throughout this entire time frame, which goes up to current. And so you can see as things were moving along in 2019 and 2020, 21, things were moving well because these all reflect net deposits to the banks. But last year, you started to see, and heading into this year, a net withdrawal status for SVB or Silicon Valley Bank. And then all of a sudden, everything just hit the wall. On March 9th, there was $42 billion in attempted withdrawals on March 9th. And basically, that pushed the bank to the point where they were not able to meet those withdrawals. They had to take a lot of heavy losses on some money that they had invested, which I'll share another slide on, and basically put themselves in a predicament where they didn't have enough of what they call capital ratios and stress testing that the banks have to go through, where they basically failed everything really, really quickly. So the next slide will expand a little bit about what happens. So typically a bank will take in the deposits from individuals, businesses, whatever the case may be, and they're basically going to do something with that money. So some of it will be lent out. Some of that will be invested so that they can earn a higher return than what they're paying out to the depositors. Well, in this case, what Silicon Valley Bank did was they invested a lot of the depositors' money into longer-term treasury bonds, mortgage-backed securities, things that in general are not overly aggressive, especially on treasury bonds, because they're going to be backed by the U.S. government. However, by buying longer-term bonds in the range of, say, 20 years, what they don't get any guarantees on is the volatility that the market can produce. And last year was very historic in terms of volatility, especially as it related to interest rates, more specifically long-term interest rates, and think mortgage rates when we talk about long-term rates, because those shot up really like a rocket ship last year in the first half of the year, and even continued to a degree in the latter part of the year. And when that happens, and this is just the case with any type of a traditional bond investment, when interest rates go up, bond prices come down. Well, Silicon Valley Bank is no different than any investor. So when rates went up really quickly last year, they were in trouble because the technology sector was already starting to slow down. Most of Silicon Valley Bank's customers, whether they're the banks or maybe the executives, are tied to the technology industry. So technology companies were needing more of the cash that was on hand at the bank. And whenever they started requesting that, Silicon Valley Bank realized, we have to sell these bonds that we invested into. Well, there couldn't have been a worse time than last year for doing so. So some of the losses they took on the bonds they held were in the 30 to 35% range. And that basically started all the chaos that took place earlier this year. What this chart shows is it says we have market value here, book value here. Best way to think of this is the higher the number, the better. The book value is what their financial statements recorded for the bonds that they held. The market value is what the market was at the time they got into these forced selling positions. So this gap, which is huge because we're talking in the billions range, was very large, and that's what caused the problem ultimately. So then there's one more slide related to Silicon Valley Bank, and it's a reflection of the deposits that the individual banking customers had. And so what this shows, again, is historical run back to 2019 and up to essentially the time when they went away as a bank. And the purple is reflecting of uninsured deposits. The sort of grayish are the insured deposits. So you have the FDIC limits of $250,000 per type of account, and under is going to be protected by the FDIC. So what this is saying, and it ended up being somewhere around 96% of deposits were uninsured, meaning they exceeded the $250,000 limit. So that created another problem because a lot of these customers are technology companies that would basically have to go out of business if they would lose all of their money. And that's why the FDIC stepped in and in this particular case guaranteed the depositors money. As opposed to just saying, anything above 250, you're out of luck. They realized there were going to be much bigger issues if they were to actually enforce that rule. So they made an exception to their process and basically guaranteed all of the depositors' monies. So, I mean, this really happened very quickly. It was only a matter of a couple of days from when it really first hit the news to where the bank was basically being taken over at that point in time. So there are other banks that have had issues. There's been several shutdowns. There are a lot of banks that are dealing with volatility right now as far as their stock price goes. So we're going to have to wait and see where all of this goes. But this is a different type of banking crisis than we had in 2008, which is really directed to the real estate market, and more specifically homes, personal homes and mortgages, and all of the bad debt that was happening in those particular situations. So we're trying to get a gauge on where this is all going to be heading. But it is a different crisis than we had back then. Now, to add another wrinkle to this is as we're still coming out of COVID and shutdowns and a major change in the commercial real estate market. Well, the big question sitting out there is how much exposure do banks have to the commercial real estate area? And as leases renew and companies either have shut down or maybe they're downsizing their space, what is going to be the impact of that? This slide is reflecting in terms of just giving an idea comparability-wise to 2008. So it's total assets lost in bank failures. We've already exceeded the dollar amount that was lost during the financial crisis. Now, part of this has been 15, 16 years since this occurred. So you have just normal kind of inflation and bringing up the numbers in today's dollars, or if we were going to bring them back into yesterday's dollars, this would look a little differently. But nonetheless, it's very interesting to see where we are right now. So this is the dollar amount or total assets in millions that have been lost. And then as you scroll over to this part, you can see in 2008, here's where we were, at that point in time. Now, what's also interesting is that in the purple are the number of bank failures. Well, you can see for this year, it's only 3 that have caused this amount. When you go to the actual year of 2008, there were 25. And then as you can see, as the crisis got worse, the numbers continued to get worse as well. It's just an interesting slide to understand that while the losses, the assets are significant, it is only a couple, in this case 3, that are really driving this particular issue right now. And yes, ultimately there are some other banks there's concerns about, but just sometimes getting some perspective on where we've been and where we are is helpful. So the big question is this banking crisis going to push the U.S. economy into a recession? So a couple of thoughts on that. Is when we look at, this is an interesting chart that reflects the banking crisis this year, kind of on a week-to-week basis. And so the way you want to read this is that anything below or in red are going to be, it's a weekly change in deposits at some of the smaller banks. So obviously when it's red and when it's negative, it's going to be, those are net withdrawals occurring at these type of banks. And you can see clearly March 15th was a peak in that, and you can see at the beginning of March, it was basically nothing. Then it jumped up a little bit. March 8th, March 15th was the biggest week. And then it fell pretty significantly by March 22nd to $40.2 billion. Then by March 29th, there was actually a net deposit happening. And then it jumped up to 23 billion the following week, April 5th. Then on April 12th, it did fall back to net withdrawal status. But at least one encouraging sign here is that the crisis that we saw back in March 15th, at least as reflected by withdrawals from the banks, which is what ultimately causes a run on the bank, or at least can potentially cause a run on the bank, seems to have somewhat stabilized. Now, the stock prices aren't necessarily reflecting that for a lot of the banks and a lot of the banking ETFs that currently exist. But I thought this chart puts it in perspective. At least things have calmed down from a deposit standpoint. So just a couple of thoughts. The Federal Reserve has had some, a lot of commentary recently from their meetings, and they've been doing some things sort of behind the scenes, even though they're public information, that has maybe, you could say, stabilized things as well. So they do feel that the banking crisis is probably going to cause a recession. You can make the case that we're already there in a recession, but those numbers will not be known for quite some time. A couple of things they've done, and I won't get too far into the weeds with this, but it's more meant to show everybody what has been occurring behind the scenes. But the Fed has opened what they call a new borrowing facility for banks. So again, think of it this way. They're adding liquidity to the system, which all things equal is a stabilizer. They've also eased conditions for emergency loans at what they call their discount window. Again, without getting into the weeds, just think of it as a way to be more supportive for the banking sector, providing more liquidity at a time of uncertainty. So the other part, though, thinking about what could happen as far as a recession, is that the Fed is still expected to tighten. When I say tighten, that means they might increase short-term interest rates more, and they probably will not lower short-term interest rates, which would be more stimulative for the economy. So if they're going to maybe tighten, increase rates a little more, or even keep them where they are right now, all things equal compared to where we were, just say 12 months ago, interest rates are going to be higher, lending conditions are going to be higher, and overall, credit ratings and credit conditions will start to slow down. So just, kind of all things equal, we're in a tighter place right now, and a potential slowdown of the economy, which we're already seeing to a degree, is taking place. Whether it hits that recession mark, that's a more debatable figure. But there's at least support being provided in terms of the banking crisis that's happening, but the increase in interest rates has already started to slow down the economy. So that's why the Fed themselves are saying that the banking crisis is probably going to cause a recession. It won't be the sole cause, but maybe it pushes the economy over the edge and into a recession. So will the Federal Reserve continue to tighten or raise interest rates as banks continue to fail, or at least really struggle? So what the consensus has been is that we could be at the end of the current interest rate hiking cycle, maybe even right now, after the last rate hike that occurred. There's been discussion whether the Fed could drop rates. It seems unlikely that that would be the case later in the year. It seems pretty likely that the Federal Reserve would not raise rates, keep them stable for a period of time to see if they're able to get inflation under control. And unless things really get dicey as far as the banking area goes, they probably would not lower interest rates this year. These are all debatable topics. There are a lot of consensus on some of these areas has taken place among different analysts, and the Federal Reserve releases a lot of their notes and minutes talking about these things. But where we are right now is that interest rates were increased this month by another 0.25%, so that now short-term interest rates are between 5 and 5.25%. And the name of the interest rate is the federal funds rate that we're specifically talking about. But we haven't been at this point for about 16, 17 years, meaning at this high of a level, just before the banking crisis in 2008 occurred, or the financial crisis, we'll call it. So I think, a lot of the impact on whether the Fed will move interest rates higher, it's still going to be based on inflation and employment. That's really the two mandates they're keeping an eye on. The banking crisis is not directly where they're going to make their decision, but certainly the banking crisis, again, could slow down the economy, could cause unemployment, and maybe not so much inflation at this point, but that's what the Federal Reserve is going to be looking at as they make their next round of decisions at their next meeting to determine if they're going to raise rates further. So the other thing that's always what's tricky about any of this is that monetary policy, which is basically what the Federal Reserve is doing as they make decisions on interest rates, it can take up to a year to really be reflected in the economy. It's not like it just happens overnight. There is a period of time that it can take. There's a lag, is what they call. So the Federal Reserve moved rates really, really quickly, historically quickly last year, and at a pretty high level. But you really don't get to see the impact until 6 to 8 months. Sometimes it's quoted as a time frame, but up to a year is potentially realistic. So we're just getting into that period now where we're a little over a year in on a more aggressive interest rate hiking cycle. So this chart's really interesting. It just gives you a perspective on how significant the interest rate increases have been in the last year and how quickly they have occurred. So you'll see different colors on the different lines on the chart. Each one of those has a different year attached to it, and these are basically different interest rate cycles that have occurred. So you can see in the period that 2015, you can see that it was a very slow, and it was like a 0.25% move every meeting, basically, is what was occurring. And you can go back to, here's 1999, before the tech bubble had burst. 2004 was more of a significant rise in interest rates. But then look at the blue. That's this cycle. I mean, it's almost a straight line up. And so that's really unusual. This chart says it all about how unusual the last year has been. And this chart's not reflective of the most recent interest rate increase. It was actually reflective of the fourth quarter of last year, but it did a really nice job outlining how different this current cycle has been from prior cycles. So when that happens, you're going to have consequences that you're not anticipating because we've never really gone through anything like that before. You could argue the banking crisis is part of the repercussions of that. So just a little more simplified chart about where we are at this point is 5 to 5.25%. So this blue line represents the federal funds target rate. And if you kind of go back to the very beginning, as I was mentioning, we haven't been this high since, in this case, the formal date is August of 2007. And here we are, at that point back then. And then you can see when the financial crisis started, interest rates basically fell right off, almost down to zero. Probably by about the fourth quarter of 2008, I believe we were down to zero. And then we stayed at zero all the way till 2016. And then we slowly started moving interest rates up about 0.25% every meeting. And then we got to the fall of 2018 and basically pushed it too hard. The stock market went into about a 20% drop in the fourth quarter of 18. There were a lot of concerns. And then sure enough, the Federal Reserve ended up cutting interest rates. And then we get into this steep drop is COVID, the beginning of COVID. And then basically interest rates staying at zero until last year, about March or so was about the first increase. And then again, a straight line up for the most part, reflecting the significant increases that have occurred. So sometimes it helps to at least have a little bit of a perspective about what has occurred and just how unusual really the last decade had been for the most part, keeping rates so low for so long. So what are the consequences? Everybody's next favorite topic on the debt ceiling is, what are those consequences if we do not raise the debt ceiling? We've been through this many times over the last 12 years or so, but this time feels a little bit different because we just have so many other factors going on, and it is a pretty politically charged atmosphere that we're in right now. So just a couple of things to think about if we do push the debt ceiling and go over that cliff, if you will. The Fed will probably, as a government, prioritize U.S. Treasury bond payments because that's how the government, how we function as a government, and really the whole world to a degree functions based on our U.S. Treasury bond system. And so most likely they would prioritize those payments. You would have an increase in market volatility. There's a lot of uncertainty about what exactly would happen in this environment. So, you have to anticipate, in this case, I'll say negative market volatility if we were to get to that point. And the other thing that's important to understand with this is that the market is a leading indicator. So another way to say that is that, if your portfolio is not positioned for this kind of potential volatility and what could happen if we do hit the debt ceiling and go over that point, then it might already be too late to a degree, because the market's not just going to wait for that day and drop off or add negative volatility to the mix. We've already seen some of that even in the last couple of months. So yeah, you need to be really in a good place already before we really push it. So what also could happen, and this did happen in 2011, credit rating agencies could downgrade U.S. debt, and that'll add volatility to the mix. The dollar is still considered the world reserve currency. That certainly could be put at risk. You have some of the day-to-day issues, like government workers would stop receiving paychecks. Another consequence from an economy standpoint, also from a market standpoint, is that you would see most likely an increase in interest rates. And so that could result from selling off of treasury bonds because of countries, individuals, whomever might own treasury bonds, not being comfortable getting paid on them. And then that's going to cause our interest rates to go up, which in this case, I'm referring to longer term rates. So that could cause higher mortgage rates and borrowing rates overall, whether it's credit card, automobiles, and the ramifications from that. That's a pretty likely scenario. That's a more market-based type of reaction in this case. So that would not be surprising at all. Now, again, on a more day-to-day basis, Social Security payments could end up being delayed if we do push it at that point. Part of it is that we have a high debt load, so a lot of the money of the government does go towards paying the treasury bonds that I was mentioning at the very beginning and the interest on them. So we'll have to wait and see. But these are some of the probably most commonly referenced ramifications if we do push it on the debt ceiling. So this gives you an idea on this slide where we are right now, and it goes back to 2005. Giving you an idea about the overall level of Treasury debt. And so you can see how much it has skyrocketed over the last 17 years. And there's a few reference points on here. The debt ceiling or debt limit, being raised on December 16th of 2021. And you can see how it just jumped up at that point in time. And here we are at the current limit and overall $31.4 trillion. So back 2005, we were at the $8 trillion level. So again, a little bit of a historical understanding about where we've been over these last 16, 17 years. So this chart is reflective of the S&P 500. And the main thing that I'm showing on this one is what happened in 2011. 2011 was the last time that we really pushed it, and maybe one of the first times we really pushed it where it became such a heavy news topic. We've always increased the debt ceiling. I think it's like 60 some times over history. But 2011, we really pushed it to the edge. And so all I want to show you on this is the blue line is the S&P 500. So as the year 2011 was kind of moving along, it was a pretty uneventful year until we reached around August of that year. And then you can see we hit a peak, and then we just fell right off at that point. It became very choppy, and then even hit a lower low, if you will. And basically, you had about a 17, 18% drop in the S&P 500 that occurred at that point. I think part of it was such a kind of a new issue to be brought to the surface like it did. The markets didn't know how to react to it. The U.S., we were downgraded in terms of our credit. That has since changed and been brought back up. Added a lot of volatility to the mix. Now, it did get fixed, if you will, in terms of having the debt ceiling lifted or increased, excuse me. The credit rating being brought back up to the really high quality that we're used to as a country. And the main thing just to show you is the markets took off. I mean, yes, it was still choppy. There was a decent drop here as we were in heading into 2012. But by the time you got to, we'll just say right about here, the markets had recovered for the most part from the peak that was achieved before the debt ceiling really got pushed to the limit. And you're dealing with the time frame around the first quarter of 2012. So the problem you have is, from an investor standpoint, is, well, what do? Do you just go to cash in this period of time? What happens? The question becomes is, what happens if it gets fixed, or maybe we don't even get to the point where this type of a drop would occur? Then you're really caught in a guessing game. So ultimately, while not a fun period, because we went all the way from August to about 6-7 months till we got back to where we were, the market did ultimately get back to that point. And then, as you can kind of see just by where the rest of the chart goes, for the most part, continued running for a number of years, arguably all the way up till 2020. So it's just, again, giving a little bit of perspective. I'm not saying it's going to be the same as what occurred in 2011. I thought it was an interesting look because of the fact it was one of the first times you really pushed that debt ceiling limit. So most importantly for investors is, well, what do you do? How do you navigate through the volatility? How do you manage risk in these times? And so, just to try to keep it simple, just a couple of items. If your investment risk tolerance is really important in this, and this is something we basically, in all of our client conversations, we're talking about risk tolerance. What's your comfort level? Nobody's comfortable with all the stuff that's going on, but there are ways to control the portfolio risk, and that's what we do. We spend a lot of time building out different portfolios so that a client's risk tolerance is able to be matched with the type of portfolio we're managing. So reviewing your risk tolerance is critical in these times. And it's not when the event's evolving. This really should be an ongoing discussion so that when we hit events like this, you're already in a really good place. So the next steps would be is, in this case, you have to anticipate volatility. And I mean negative volatility in this case until this gets worked out. It's just the nature of the beast, whether it's the war in Ukraine, whether it's COVID, whether it's going to be the debt ceiling, we're always going to have events that cause an increase in volatility. So you have to anticipate that. The markets don't run in a straight line heading upwards. And so you want to make sure you're making any adjustments before these issues really crop up. And so that's kind of the second step in this process. And then, it's really tied into number two, is you want to analyze. You want to analyze all of your existing holdings. You want to be able to take a look at how the sectors break down. When I say sectors, I mean like technology, for example. There are ways to build your portfolio to try to cushion some of the downside that can occur. And you can look at last year as being in a longer period of time, but a period of time where the markets were pretty relentless in their drop throughout 2022. And ultimately is understanding too, if you've got a portfolio of exchange traded funds and mutual funds, you might not be as diversified as you think. And there's a lot of ways you can go through and analyze that. And we do this for all of our clients, is making sure that the investments we're using in the portfolios, there's not too much what we'll call overlap, because then you don't get as much diversification as you think. And therefore, you're probably going to suffer bigger losses than you would anticipate otherwise. And then I think the biggest tie-in ultimately is, what about your financial plan? What does that say? So you really don't want to be in a position where you have to change your financial plan. And yes, it's about focusing on long-term goals, but I also understand, you have to get through these periods of time where you have the markets are going to be potentially very volatile. But you do, to some degree, you've got to be able to ignore the daily market fluctuations and think about the long-term plan, a long-term retirement projection. Is anything really changing? And is your portfolio in a place where, yes, it can take some of the volatility that's going to happen? And the question then would be is it going to impact your long-term plan? Well, part of what we're able to do for our clients is tie the two together. So you don't have to be some client situations, you don't have to be taking on an extraordinary amount of risk to make the financial plan work. So that's why I think all of these parts are really important to continuously monitor, and that's part of what our job is, working with our clients on this. So what about opportunities? Talking about a lot of negative issues, and I think rightly so given where we are in the news cycle, but there are opportunities for growth, diversifying the portfolio as the world has changed. And the world has really changed from an investment standpoint a lot in the last 12 months, especially as it relates to interest rates. So a couple of things on this slide. is this is about inflation expectations. And so this was produced in December of last year, but I thought it did a good job just kind of showing you where we've been. We've been all over the place as far as those expectations go. The orange line is a 5-year break-even inflation expectation, and the blue line is a 10-year. I'm not even as worried about comparing the two. I just wanted to explain how the chart looks and why it's set up this way. I think the main thing is that if you go back to March of last year, that's when the inflation expectations were really started in February, were ratcheting up very quickly. And then pretty much from that point, again, this is an expectations chart, it's been falling pretty consistently. Now, there was a bump towards the fourth quarter of last year that basically fell off as we headed into year end. And yes, there was another little bump that was occurring toward year end. I think the main thing is that the overall trend, you can see for the most part, has been heading downward, which is why we've seen long-term interest rates go up. And that's why we've also seen the more traditional bond market actually has been rallying for some time, even though the bond market had one of its worst years last year. So there's opportunities with the bond market, for example, in terms of how you allocate your bond allocation. Now, inflation expectations, they certainly could bounce back up to a degree. And then you have the debt ceiling issue. If we do push over the edge, long-term interest rates would probably go up. That could be a negative for traditional bonds. So there's a lot of juggling you have to do when you're looking at this information. But I think the main thing is that if you don't know what's in your portfolio as far as it relates to bonds, you want to take a deeper dive into this. Then I'll show you a couple of pages at the end of the presentation that give you an idea of how we do this for our clients. We've only got about a handful of more slides to go through. So this chart is showing what is happening right now as far as gold versus regional banks. So the two lines, the gold line is going to be for what is called a gold miners index. So the one thing that's important to note here is that this gold miners index, the underlying holdings are equities, they're stocks of gold mining companies. So these are equities. And then for the light blue, this is a regional banking index. Again, the underlying holdings are banks, regional banks. So they're equities. It was just an interesting way to show how bad things have been for the regional banking area. You're down 30% or so, at this point in time. But gold mining stocks are up about 25% or so, at this point. This isn't a recommendation you should be plowing into gold mining stocks or anything like that. The point of it is that even in times like this, where things are just really such a big question mark, there are ways that you can diversify your portfolio, earn some money in a period where, of course, banking's just been awful this year because of everything we covered, and that's only been really since March of this year. Now, the other area, too, that's interesting to note is that, at least in our client portfolios, most of our client portfolios have an allocation towards gold. In this case, I mean the actual gold bullion. And so that's up about 10% or so this year, and it's a better diversifier than even this gold miners index. But I just like the way this chart kind of laid it out, showing you such a wide difference in returns at this point. So this has been a big question, probably comes up almost every meeting, is in terms of what are you earning on your cash at this point in time. So this gives an idea just where we are with rates. They've gotten better as it relates to what you can get on your cash. However, the big banks, you're not necessarily seeing this. It's, you're lucky if you're having any kind of interest rate on your just straight cash in terms of what you have in your checking account. The average savings yield is still well under 1%. Now you can get a high yield savings account that has an interest rate pushing 4% as far as the APY, which stands for annual percentage yield. And then one of the things we've been able to help our clients with, and this is within all of our client portfolios, is that we have an attractive money market fund option we're able to use right now. And that money market fund's pushing 5%. I think it's at 4.82%. And it's a mutual fund. It has a one-day settlement, and the underlying holdings are very high quality treasury type bonds, some mortgage-backed securities. It's very higher quality investments. And for one-day liquidity, and basically no fluctuation in terms of the price, which is $1 per share, and we're getting close to 5%. So what we did later last year when we were able to find this option is we moved a decent part of any of our clients' cash into that money market fund. We kept some in cash just for flexibility, but we were able to shift a decent part of our clients' cash at that time into the money market fund. And that's worked out really well. We've had some clients that have ended up taking excess cash and using the money market fund because it is a pretty attractive return without having to take on risk. So it's been great for our portfolios because we're able to get close to 5%, at least on a 12-month basis going forward with cash or money market fund, if you will. And that helps stabilize the portfolio. That's not a long-term decision because you still have to keep up with inflation, but going through a big transition like we're having right now with the debt ceiling, the banking crisis, it's given some stability for our portfolios. It's not like we have all of it allocated to the money market fund. It's probably between 10 and 15%, somewhere in that cash or money market fund area. It just depends on the portfolio. But it's a nice jump. We're able to see that we couldn't see as recently as about 14 months ago, because even there you were basically dealing with 0% rates across the board. So the next two pages, I broke down one of our research tools, and these are the last two slides, and then I'll take questions and answers. But this comes from a software that we use called Morningstar. And what it allows us to do is it allows us to break down our clients' portfolios, or if we're meeting with a prospective client, we can easily break down their portfolio in at least pretty simple terms in regard to having a pie chart we're able to refer to. And all this pie chart does is really break it down at a kind of a high level. So it shows there's an allocation to cash. And this is representative of one of our portfolios of approximately half equities, half bonds at this point in time. We have U.S. stocks getting 34% of the portfolio. Non-U.S. stocks about, call it 5%. Bonds are at about 40%. There's another category just called other or not classified is what that stands for. And that can include some asset classes like gold, commodities, managed futures that we're using in our client portfolios that we deem those to be equities for purposes of building out the portfolio. It's a nice chart because it just gives it at a high level. Now, of course, from there, we break it down much further. So, and I'm not going to go through the entire read on all the numbers. It's more meant to show for our clients understanding what we're doing behind the scenes and allows us to monitor the portfolio very closely. So it breaks it down by, these are the equities. So it breaks it down by cyclical, which are going to be really sensitive to the economy, sensitive, which will be sensitive to the economy, and defensive, which are still equities, but they're not so much tied in with the economy. And so the bold covers the percentage of the equities of the portfolio. And you can see 20% are in defensive. I'll just round these up and say 38% for sensitive. And cyclical, we'll call it 42%. But it doesn't stop there. It gives a breakdown into some of the subsectors, if you will. So of this 41%, you can see the top four and what those allocation percentages are. Under sensitive, the same thing. Under defensive, the same thing. So you can see where we have some of our tilts in terms of our investment portfolios right now. Healthcare has been a really good area to be in. Technology has been and was a really great area to be in until last year. We reduced our position in technology towards the beginning of last year to take a lot of gains that we had on the table. And it was using this type of a report that alerted us to, well, we probably should make some moves there. And the technology area has actually had a decent rebound so far this year. So that's that is our highest allocation by sector. Again, these are percentages of the equities. So another way to look at this would be 22.08% of the equities, which is targeted at about 50% of the portfolio. So it just gives you a flavor. It gives us a really good understanding because as you're building out the portfolio and you use different mutual funds and ETFs, exchange traded funds, the software takes all of the underlying holdings and brings it all together so that we know where we are in these different areas. Because if you're not careful, you might buy 5 investments that look like they would have no technology in it, but they really might. And so that this type of a report would help you with that. Over here gives a geographical breakdown. So again, at a high level, the Americas, which are defined as North America and Latin America, 92%. Greater Europe is about 5.5%, and then they do break down the subcategories within it. And then Greater Asia is about 2.8%. So it gives you a flavor, if you think about it from an international standpoint, so we're about, call it 91.5%, more really U.S. based, and then the rest will be international, and it breaks down from there. The other thing to share on this page is we do the same thing with the bonds. And so it breaks it down by what we'll call sector. We have government bonds. Again, these are percentages of the bond allocation, which is about 50% of this particular portfolio. So government's about 18, corporate is 46, securitized is 27, and that's basically a loan that has collateral behind it. True cash is about 6.39%. So again, it gives us an idea of where the portfolio is, how it adjusts, how maybe it is adjusted during the year. If we're making a change to the portfolio, we can add and subtract and see how all these areas change. And we have a target we're looking for. And so right now, we're very comfortable with our targets on the bond and equity area. It then breaks down into credit quality. And we have a nice mix right now of very high credit quality. And we have some that are lower in terms of in the B range, double B and single B. And the reason for that is that we've had a pretty strong economy until the last year maybe started to slow down a little bit with all of the issues out there. And we've actually increased the credit quality of our client bond allocations. Last year, if you were in the high credit quality area, you got hit really hard performance-wise in a negative fashion. So going into last year, we barely had anything in the high credit quality area. We had mostly a lower credit quality area. Those areas held up extremely well last year in the markets, and now this year we've been repositioning the portfolio to handle a change in that situation. We'll probably move a little bit more on the higher quality side, but we got to get through the debt ceiling issues first, because that could really cause a spike in interest rates. So the main thing just on this page is the tools we use give us the ability to quickly identify areas that maybe are over or under allocated. And the last page that I will share with you is just, again, related to the first part is related to bonds. And so the key thing here, these are called style boxes. The main thing we're really looking at for our bond allocation is a term called duration. And this is reflective of interest rate risk, the risk of rates going up and bond prices coming down. If you're going to look at this about 12 months ago, 15 months ago for our clients, we were under 1 for duration. So the lower the duration, the lower the interest rate risk you're taking on. We have purposefully made a couple of decisions later last year where we wanted to increase duration because rates went up so high. Again, the main takeaway is that we were able to kind of plug and play within our client portfolios, get it to the right area that we're targeting for the duration. And then the last thing I will share before taking Q&A is this style box. This is reflective of equities. So the way this reads, it's a little confusing at first glance, is that for the term large, this stands for large cap stocks, mid cap stocks, and small cap stocks. Then across the bottom, this covers the style of investing known as value investing. This one covers growth investing, and a blend is going to be a blend of the two. So we've got a lot of numbers going on here, but again, it's sort of like a plug and play. We're matching up how much do we want to have in large cap value. Right now, we know that's 11% of the equities in the portfolio, and we're good with that. We have a target of about 40% in large cap, about 30% in mid cap, and about 30% in small cap. These are targeted figures we're looking for when we make adjustments in the portfolio right now. We have a little more of a tilt towards value because value is pretty inexpensive at this point. Growth is still, even after last year, still a bit pricey and is actually subject to concerns if long-term interest rates were to jump up again. So we don't want to overload in any particular area. So it gives us that ability. If we were going to add an investment, we would just put it into the allocation. All these numbers to some degree would change. And before we do that, internally, we have an idea of what we're targeting. And so it's just a matter of finding those right adjustments at the right percentages with the right fund to make that happen. So I'll leave it at that. It might be a little bit too granular getting into those details, but I think as we're talking about opportunities in an environment that is, concerning with the debt ceiling, there are opportunities. You just have to have a pre-made plan on what you're trying to do, and then using a tool like this allows you to really put the plan in motion. Oops. I will take, with that, questions and answers. And I'll just hang in there for just a second. Okay, so the first question that comes up is how often do we update our slides, or not our slides, excuse me, the Morningstar pages, those last two slides that I did review with you. So the nice thing is about with any of these software programs is that they're really updating constantly because of the change in pricing. It's something we probably look at a lot more when we're about to make a change, but we look at it pretty consistently because sometimes, if you have an asset class, say, I'll just point on technology again, that it's such a wonderful run for about a 5-year period. It just, the percentage of the portfolio just came to be way too high. And so by us constantly monitoring it allowed us to really trim those gains back before that part of the market started to fall apart. So it's something that, certainly as we're making changes, we're going to be looking at all the time, but it's something we are consistently reviewing. Every day we get a listing of our investments that we use, how they perform for the following day, how they're doing year to date over a 1 week, 3 week, 1 month period. Just we're able to gauge really quickly before the market even opens for the following day, how things performed the prior day, including a run of our client portfolios and how they held up for that 1 day period. And then what we do is we meet every day as an investment committee so that we can talk through maybe issues that come up on those reports, maybe something new that's come to light that we need to address. And that way we're able to stay on top of what's going on. So another question is regarding break-even inflation and what is that? And so there's a type of bond called a TIP. It stands for Treasury Inflation Protected Security. And so the idea, they feed off of kind of the break-even inflation. So a way to think about break-even inflation is going to be the point of a treasury or a TIP is going to be to try to capture returns based on inflation, and in this case, especially based on unexpected inflation. So that's what the point of the Treasury Inflation Protected Bond would be for. And a question that came from that is, well, they didn't do very well last year, yet inflation, as we know, really reached into areas we haven't seen since really the 70s. And the problem with the TIP, with the Treasury Inflation Protected Security, is that even though inflation jumped up a lot last year, it's still a bond. And because it is still a bond, it's subject to interest rate risk. So the risk of rates going up and prices coming down. So it was really no different. It was still subject to the same type of risks. So hopefully it helps a little bit in terms of understanding the inflation, the break-even inflation rate, because the whole point of it is for usage in a Treasury Inflation Protected Security is to be able to capture those type of deviations or those differences. So, and maybe another way to put it is it's a way to compare a 10-year Treasury bond rate minus the TIPS rate. So that difference is going to be what is considered to be break-even inflation. Okay. So another question that came in was about how high can the Fed raise interest rates before it becomes too expensive to service all the Treasury debt out there? And that's a great question. And that's certainly a concern, is that we've been at 0% interest rates for the most part, again, from 2008 until, we'll just say, at the beginning of last year. So there's a lot of ramifications that come from that. But one of those is the fact that the interest expense on our government debt has been really low, meaning in terms of the interest expense itself relative to the overall economy. And think of it the same way, even for a consumer that's benefited from low interest rates. Well, if you're looking to buy a house, you can afford more house in theory because you are having really low interest rates. But if those rates go up, you're not going to be able to afford as much house. And that's basically the issue there. So as interest rates go up, then the debt it will continue to be there, but it'll start up at higher rates, which will cause the interest expense to be much higher. So it's hard to answer the question specifically about how high they can raise the rates, because the bigger portion of the budget will go towards interest expense as opposed to other things. So it's a real issue. So another question about with interest rates as high as they are, is short-term investment in CDs or bonds a wiser move for my available funds? So maybe like a reserve, I'm assuming, something like that. And yeah, I think CDs still aren't that attractive. There have been a number of questions that have come up from clients on like a 1-year CD, where the interest rate on that 1-year CD was actually lower than even the money market fund were able to get. So rates on 1-year CDs certainly are a lot better than they have been. But if you can find an attractive money market fund option, you might be able to get even just say the same return without having to lock up your money for a year. So, and as far as bonds go, you just have to be careful about how long of a maturity you're getting. There are mutual funds and ETFs that exist that focus only on short duration bonds. And, so that could be an area where you could maybe get some of the higher returns as interest rates continue to rise, but you are taking on, whether it's credit risk, interest rate risk, you are taking on those risks. So again, for us looking at this for our client portfolios, we have short-term bond funds that are clearly options for us. They just haven't been attractive enough compared to the money market fund rate. Now that day will change once rates start to maybe get ready to go down again, but that's not where we are at this moment. Hey, another question, what financial characteristics for our investments are compelling to you as we wade deeper into the banking crisis? So I think a couple that I've mentioned, even the money market fund, I would put in that category. Using more of the traditional bond funds has been a good thing to do because long-term rates have come down, and when that happens, bond prices go up. We've had in the portfolio since 2019, I believe, we've had gold, and gold is having a really good year this year. We added managed futures to the mix last year, which is a different kind of an asset class that actually was able to earn money while the markets were falling off last year. Those have been compelling areas, just to name a couple, because they're able to benefit from short-term interest rates having gone up. And they've been basically, those type of asset classes have been out of favor for about 15 or 16 years. And so those have been really compelling to reintroduce back to our client portfolios for that reason, because they really do diversify the portfolio, reducing volatility while not harming long-term returns. It's always, if you want to make higher returns, you think, I got to take on more risk. And normally that's going to be the trade-off, but you get some periods of time like this where you can actually enhance the expected return and take down risk. Those are a couple of areas specifically that we've been able to use. We've added merger arbitrage strategies back into the portfolio. While that sounds aggressive, it's not. It's actually a very low volatility strategy. that is able to earn mid to high single-digit returns over time while lowering risk. So that's another example of that. And then from a standpoint of areas where we're invested in equities, we're looking at sectors of the market that are just less expensive. And if you're buying an investments that are less expensive and the markets go through turbulence like last year, well, you have less room to fall. And so, we experienced that with some of our investments last year. They held up really well in an environment where growth investing was what got hit the hardest, you could argue. So even having some more value or investments in the portfolio, like we've had over even the last couple of years, that's actually been really compelling because some of them actually made money and some of them maybe just didn't lose anywhere near what the markets lost last year. So those are also exciting areas. And I mean, it's interesting just being excited about putting a money market fund and using that to a degree right now. We've been happy to do it. Again, it's not going to be a long-term strategy, but given where we are, at this point in the cycle, that's what that's what we're doing. And we recognize we have a lot of headwinds coming as it relates to the banking issues and the debt ceiling. Let me see if there's any, what about another minute or so, see if there's any other questions. Now I'm going to just do a better job, hopefully do a better job of explaining the inflation break-even, the break-even inflation question. So a more specific way to think about that is that the break-even inflation rate is going to be the difference between, say, a yield on a bond and the real yield on an inflation-linked investment, so like a TIP. So it's where you're comparing the two and then subtracting basically the inflation-linked yield from the nominal yield. And I'm still not doing a great job explaining that. We have a good slide. I almost feel like I want to pull up to better explain that, but I'm not sure if I can locate that one. But it's basically, that's how the calculation works in terms of what the break-even inflation rate is. So it's the difference between the yield on a bond, like you would normally look at, and the real yield on a TIP, a Treasury inflation protected security. That's technically what the definition is. Okay. Well, no other questions are coming in, but if you have any questions, feel free to reach out to us, and we'll be happy to talk them through specifically to your situation, or if there's just questions in general that you have. But we appreciate you making the time to attend the webcast today. I'm going to turn it back over to Dan.
Okay, great. Thank you, Jim. A lot of great information you covered today, and timely as well. And I want to thank everybody for joining us today for the webcast. If you'd like to schedule a free conference call consultation with a member of our advisory team, please call our office at 412-635-9210 to set up an appointment. Thank you again for attending, and this concludes the event.